So remember that the Federal Reserve is the central bank of the United States, and its job is that it's supposed to keep inflation and unemployment low. It's supposed to keep the money supply pretty steady so that people can borrow and people can spend and the economy can keep working. And so they have the power to create and disappear money through those three tools that we talked about the Fed using. Open market operations to control the federal funds rate, the discount rate that the Fed loans money to banks directly, and the reserve ratio requirement, which is the amount of money banks need to keep in the vault and not lend out. And so let's talk a little bit about how inflation works. So first, what is inflation? Inflation is just a general increase in prices. Inflation is a general increase in prices. And what usually happens is, just like we hear from grandparents saying, well, back in my day, things used to cost only 10 cents. Today, something might cost $10. And then in a year, it might cost $10.05. And after 20 years, it might cost $25. So prices tend to go up. Why is that? It's because the money supply is growing. And if money keeps being created, then every dollar that's left is worth a little bit less. So you have to spend more to get each thing. So if the money supply gets too big, prices start rising too quickly. And that is bad for the economy. So inflation is a general rise in prices in an economy. And it happens when the money supply expands too fast. And the Consumer Price Index is one way to measure how much prices are going up or going down. That's called deflation if prices go down, but normally we have a low level of inflation, prices going up a little bit. And the Consumer Price Index, or CPI, is a measure of the average prices paid by urban consumers for a fixed market basket of consumer goods and services. All it is an average of the prices of things that we need to buy. That's all it is. And then they take that same group of things we need to buy and measure how much it costs one year, and then the next year, and then the next year, and see if it goes up or goes down or what happens to the price. So let's look at a couple of videos really quickly to see how that works.
The Consumer Price Index, or CPI, is considered the benchmark inflation guide for the U.S. economy. It uses a basket of goods approach that aims to compare a consistent base of products from year to year, focusing on products that are bought and used by consumers daily. The price of your milk, eggs, toothpaste, and haircut are all captured in the CPI. The CPI is calculated by taking price changes for each item in the preset basket of goods and averaging them, with the goods being weighted according to their importance. The index uses a base year for comparability of its calculations, so changes will often be provided on a percentage basis to reflect only changes to prior index levels. There are two CPI figures, the CPI for urban wage earners and clerical workers, the CPI-W, and the CPI for all urban consumers, the CPI-U. The most watched metric is the CPI-U, which is often presented with a seasonal adjustment, as consumer patterns vary depending on the time of year. The CPI is a detailed release with breakouts for most major consumer groups and geographical regions. The CPI is also used to identify periods of inflation or deflation. Large rises in CPI during a short stretch typically signal periods of inflation, and large drops in CPI during a short period usually mark periods of deflation. As well, the CPI is used to make changes to cash flow mechanisms such as pensions, Medicare, and cost of living adjustments. This versatility means the CPI affects nearly every market and person in America.
Now, all of that information isn't going to be on the test. Just the general idea that the CPI is an average price of goods that you need to buy, goods and services that everyone needs to buy, and measured each year to see how prices change. So let's review quickly what is expansionary monetary policy and contractionary monetary policy. Expansionary monetary policy is when the Fed buys securities to send money into the economy. This lowers interest rates because banks really want to loan out that extra money that they've got in their banks. They can lower the discount rate, which is the rate that banks can borrow money directly from the Federal Reserve, making it easier to make out loans, increasing the money supply. And they can lower the reserve requirement. But this almost never happens because if they shrink the reserve requirement from, say, banks have to keep 10% of their money in the bank to banks have to keep 5% of the money in the bank, they're going to loan out a lot more, and it'll make the economy more fragile because if people want their money out, banks are going to be in more trouble. All of this tries to get more money into households and businesses to increase spending, which is aggregate demand. That's the whole goal of monetary policy, expansionary monetary policy. Get more money into the economy so that people are spending more and the economy gets better. Contractionary monetary policy is when the Fed sells securities. They sell securities to banks and the banks pay money for them, and that money leaves the economy. This increases interest rates because banks have less money to lend out. The Fed could increase the discount rate. Remember, the discount rate is the interest that the Federal Reserve charges banks that want to borrow money from them. If they increase the discount rate, then fewer banks will borrow money from the Fed and fewer banks will lend money out to the public. And they could increase the reserve requirement, going from, say, banks having to keep 10% of the money in the bank to banks having to keep 20% of the money into the bank. That would mean that there's just less money that banks are allowed to loan out. All of this tries to get money out of the economy to slow down spending. If it's harder to get loans, if it's harder to, and people are more interested in saving their money because they get more interest rate, then people are going to save their money, not spend it, and people aren't going to take out loans to spend either. And that slows down the economy. It also slows down inflation because if there's less money in the economy, then prices will start falling down. And this is one of the big differences between the different schools of economics that we've looked at. Keynesianism and monetarism are the two most recent ones. Classical economics, we also talked about at the beginning of the unit, that just says let markets solve it themselves, the government shouldn't be involved at all. Keynesianism said government should spend money to stimulate the economy. And even if that means deficit spending. Deficit spending, remember, is when you spend more than you take in, and you have to borrow money and take on debt to do that. And Keynesianism says government should do that when the economy is bad because people aren't going to be spending money, so someone needs to stimulate the economy. Monetarism says that the government shouldn't do that. It shouldn't borrow money and spend money because the government isn't very good at spending money on the right things. People know better what to spend their money on. And so they should just try to make money easier for people to take loans out and spend because then they'll spend money and it'll stimulate the economy. But then let people do that. And they do that by controlling the money supply. Either expand the money supply or contract it. And then let people decide what to buy, not the government. So those are the two big differences among those two camps of economics.